Hi, this is Jessica Dunn, and today we're going to talk about the security market line. Market risk, which is relevant for all stocks that are held in a well-diversified portfolio, is defined as the contribution of a security to the overall riskiness of a portfolio. So before we said that a well-diversified rational investor is going to care about how a particular security's risk affects their portfolio. A good measure of that is beta. So beta is um, a measure of the non-diversifiable risk that a security holds and how that will play into the portfolio. So the tendency for a stock to move up or down with the market is reflected in the beta coefficient as well. An average risk stock is defined as a beta equal to 1. So the market is a beta of 1. So how are betas calculated? Um, Beta also measures volatility relative to the market. So we need to look at a stock's return relative to the market return to calculate our beta. So to do that, we use a regression line. We run a regression where we plot the returns of the stock on the y-axis and the market portfolio returns are plotted on the x-axis, and we find the line of best fit. The slope of that line of best fit is the stock's beta. We typically use historical returns to calculate beta, but the time for which you use the historical time frame can be different dependent from one researcher to the next. So you may have like a 3-month rolling window of historical returns to calculate beta. You could use the previous year's returns, the previous 5 years returns. It really just depends. So we're going to plot the the PQU stock returns on the y-axis, and the market portfolio returns are on the x-axis. And so here we see that. We find the line of best fit, and the slope of the line of best fit, that 0.83, is the beta. So when we're talking about the market return, we need to discuss what is comprised of the market. Most analysts are going to use the S&P 500. Um, the more stocks that you include in the market return, the better. So if you had a stock index with more stocks in it than that, then that would be preferred. Um, and analysts typically use 4 to 5 years of monthly returns to establish the regression line. Some analysts use 52 weeks of weekly returns. So if beta is equal to 1, the stock has average risk. If it's greater than 1, the stock is more risky than average. If it is less than 1, then it's less risky than average. Most stocks have betas from 0.5 to 1.5. So to find a stock's beta, you can look on Yahoo. About every financial website is going to have betas listed there. But if you go to Yahoo Finance and enter in the ticker for the stock that you're looking for, the quote will come up, and on the key statistics panel, you can find the beta of the stock. So if we were looking at the same example that we've been looking at in these series of presentations, this alta that moves with the market and the market return, American foam, which moves with the market, treasury bills, which is the riskless security, and repo, which moves counter to the market. We could also calculate their betas, and we see that alta has a beta of 1.29. So that means it is riskier than the market. It is 29% more volatile than the market. American foam has a beta of 0.68, so it's less volatile than the market. It moves in the same direction. It's positive. So when the market's increasing, American foam is increasing. It's just not increasing as much, so it's less responsive. Repo Min has a negative beta. That means it's moving counter to the market. So when the market is doing well, repo is doing poorly. And it is less responsive than the market as a whole, because when we look at the absolute value of that, it would be 0.86. So that means it's less than 1. So it would be less responsive than the market as a whole. But the negative sign means it's moving in the opposite direction. We can use the security market line to calculate the required return for a security. And so to do that, the required return of a security is equal to the risk-free rate of return plus the market risk premium times the beta of the stock. So let's assume that the risk-free rate of return is 8% and the market return is 15%. So it says that the required return of the stock is equal to the risk-free rate of return plus the market return minus the risk-free rate times beta. This together is called the market risk premium. Market risk premium. So let's plug in what we know. The risk-free rate of return is 8% plus the market return of 15% minus the risk-free rate of 8% times beta. And our beta in this example was 1.29 for Alta. So let's go ahead and calculate that. We have 15% minus 8%, multiply that by 1.29, and then add to that 8%. And we get a beta, or a required return of 17%. Required return is 17%. Now we could do that for each of our securities. So the market return has a required return of 15%, American Foam has a required return of 12.8, the Treasury bill 8%, and repo has a required return of 2%. So if we compare that to the expected return that we calculated in previous discussions, we had found that Alta had an expected return of 17.4% and only a required return of 17%. So it's earning more than what is required. So that means it's priced low, it's undervalued. The market is fairly valued because the required return and the expected return are equal. American Foam is also undervalued because it's earning a higher rate than what is required. Repo is overvalued because it is earning less than what is required. So it's priced too high. So if we look at the security market line, we can also see this as well. We see that those that are listed above the security market line are undervalued. Those that are below are overvalued. So that corresponds with what we had just found here. So let's calculate the beta for our portfolio. To calculate the beta for our portfolio, it's simply the weighted average of the individual securities betas. So it's a real simple formula to use. So if we had a portfolio that's comprised of 50% Alta and 50% repo, we just take 50% of Alta's beta, which was 1.29, and 50% of repos, which was a negative 0.86, and together we get a portfolio beta of 0.22. So that means that this portfolio it moves in the same direction of the market, but it's not very responsive at all. So it's not going to move nearly as dramatically as the market does. So the required return on the Alta repo portfolio, we calculated the beta. Let's calculate the required return. We could use the security market line and just plug in our beta. We had already said that the market return was 15% and the risk-free rate was 8%, which gave us a market risk premium of 7. And that gives us our portfolio required return of 9.5. Alternatively, you could use the weighted average of the required returns, which we had just calculated here. We said the required return for Alta was 17 and the required return for repo was 2. So there's two methods to get to the same answer, just the weighted average of those required returns. Either way, you get 9.5%. So the required return on this portfolio is 9.5%. Let's see what happens if we have inflation. If we have inflation, it causes our security market line to increase. So it's going to cause a shift in the security market line. It's going to cause the entire line to move up. And that's because the risk-free rate has changed. So when we look at our required return is equal to the risk-free plus the market risk premium times beta, the inflation is affecting our intercept point. So that causes the entire line to shift. If instead we had a change in risk aversion, then that's going to cause a change in the slope of the security market line. It's not causing a change in our intercept, it's going to cause a change in the reaction to the risk. The capital asset pricing model is just a theory. It has not been completely confirmed or refuted. Statistical tests have problems that make verification or rejection almost impossible. Because required returns are based on future risk, but we don't know what's going to happen in the future. We only have historical betas. So we don't know how to capture the future risk of a stock. All we can do is assume that it's going to be similar to what's happened in the past.